अखंडमंडलाकारं व्याप्तमेन चराचरं तत्पदं दर्शितं येन तस्मै श्री गुरुवे नमः. Namaskar, dear friends. Here I, along with my partner Dr. Abhijit Vishwas, have made a modest attempt to present to you the course on SWAYAM portal in the name of Essentials of Financial Management. There we have discussed the concept of finance, capitalization, theories of capital structure, leverage, sources of finance, capital busting, and today we are going to start a new module that is based on the working capital management. And here in this particular unit we are going to discuss the important concept associated with working capital management, including the concept of working capital, the composition of current assets and current liabilities, the significance of working capital for a business, the circular flow of working capital, this is also known as the operating cycle of working capital, the classification of working capital based on the composition of assets and the liabilities and also on the basis of the time for which it is required. Then we can also discuss the challenges of working capital, and finally the factors which determines the level of working capital in any business. So, let us start with the concept of working capital. Here working capital refers to the liquid resources available to a business to run its day-to-day operations. So, working capital is associated with the investment decision, as previously we have discussed that a manager has to take three important decisions: financing decision, where he has to decide how much fund is to be raised and from what sources. The second decision was investment decision, where the manager has to decide where to invest and in what amount, and this investment decision was categorized into two parts. The one is the long term investment, where the capital busting techniques are very helpful in deciding the projects to be selected, whereas the current asset management, which is basically known as the working capital management, deals with the problem of managing the fund which is available with the company for day-to-day operations. Now, here it is a fundamental concept which is also going to affect the financial health of the company and its operational efficiency. Now, why the working capital seems to be very important for any business? It is for the fact that when the company has enough working capital, it can pay to the employees and supplier on time. Secondly, it can also invest in the training of the staff member, which would in turn bring the customer experience in a most profitable manner. The company can also have the increased advertisement budget with the enough working capital, and we know this is considered to be a tool for increasing the sales of the company. And there are some unforeseen events which can also be managed if the company has the sufficient working capital. Now, just to start with, I would like to share with you how the working capital components are related to one and another. Now, the cycle starts with cash. Now, cash is used to purchase the raw material, and this raw material, when it is used in production process, it is converted into work in progress. Now, this work in progress is also known as the semi-finished goods, which will be converted into finished goods. Now, finished goods are ready to be sold out in the market, and then there are two options before a company, either to sell this finished goods on cash basis. So, sales would directly be converted into cash, and hence the working capital cycle will get completed. But sometime, keeping in mind the competition and the demand of the product, the company cannot afford to sell the goods on the cash basis. So, there it has to take the help of receivables, where the company is selling the goods on the credit basis, and once the debtors are converted into cash through a rigorous collection procedure, then only the working capital cycle will be completed. So, this was the circular flow of working capital, or it is also known as the operating cycle of the working capital. Now, after having gone through the concept of the circular flow of working capital, it is important to discuss the different classification of the working capital. Now, here the working capital can be divided into different parts based on the two important criteria. Number one, on the basis of composition, this can be divided as a gross concept of working capital and also as a net working capital. On the basis of time for which it is required, they can be permanent working capital and also the variable working capital or the temporary working capital. Now, let us see the classification based on the concept of working capital. Now, here there are two categories of working capital based on their concept or the composition. One is known as the gross working capital concept. Now, according to this concept, the working capital would refer to the sum total of all current assets employed in the business process. That means, every component of current asset, whether it is cash, account receivable or inventory or the marketable securities, it will all come under the purview of the working capital. That means, it is emphasizing on the firm's investment in current asset without considering the current liability. But we know that every current asset has to be used for meeting out certain current obligation. So, that is why the net working capital concept comes into picture. According to this concept, working capital is the excess of current asset such as cash, accounts receivable and inventory over the current liabilities, which includes the component like accounts payable, the short term debts, etc. So, net working capital basically is the difference between the current assets and the current liability, and it represents the liquidity position of the business and indicates the ability of the firm to meet its short term obligation, where the positive working capital, that means the excess of current assets over the current liability, suggests that the company is financially strong and it is running its businesses smoothly, whereas negative working capital can determine or can indicate a serious liquidity crisis or liquidity issue in the company. So, these two concepts are different in the sense that where the focus of gross working capital is on managing the individual current assets, but the net working capital would emphasize how the current liabilities are going to be met out of the available current assets. So, these are the two important concepts. I hope you have understood the concept of current assets and current liability, giving the phenomena like the gross working capital and the net working capital. So, now when we have to discuss the gross and net working capital in detail, it is very important to study and learn that what are the component which comes into the current assets and the current liability. So, here this is going to present a picture of all the important items of current assets and the current liabilities. So, current liability includes the trade payable, outstanding wages, then bills payable, accrued expenses, provision for taxes, unearned revenues and also the some current portion of long term debt, whereas the emphasis of current asset would be on the component like the cash, the bank balances, the sundry debtors or the accounts receivable, the raw material, semi finished goods or the work in progress, finished goods, short term investment, some prepaid expenditure and advances to the supplier. Let us quickly discuss these important constituents of the current assets. The cash and cash equivalent, what does it mean? This denotes the cash available with the bank of the company or the company itself, and the main component includes this certificate of deposit, the money market fund and short term government bond and treasury bills. So, these marketable securities, they are the near cash item. So, can be liquidated at any time without any significant loss or without any significant delay, and that is why they have been kept as a current asset, not the fixed assets. Now, the account receivable is the value of goods services which had been delivered to the customer, but the customer has yet not paid for the amount of goods and services he has received. Now, the third component is inventory, which is the raw material, work in progress and finished goods, and prepaid expenditure includes the advance payment that benefits the business such as prepaid rent and insurance premium, right. So, these are the important ingredients of the current asset. Now, we can discuss the current liability and its component. this includes the account payable. That means the company has taken the goods on credit basis, but it has not paid to the supplier. There are some outstanding wages and salaries which yet to be paid to the workers and the employee of the company. There are accrued payroll, that money owed to employees such as retirement plan and the matching contributions, sometimes the taxes which has been due but not paid by the company can also come under the current liability. The basic difference between the current nature of asset and current liability and the fixed nature of asset and liability lies in the fact that all the current asset and the current liability have got the maturity period of one accounting year. That means the 1 year. Current asset has to be converted into cash within one accounting year, whereas the current liability has to be paid within one accounting year. So, with this I hope you have understood the composition of current asset and current liability. Now, with this important graphics I can tell you what exactly is the gross and net working capital. So, here I am going to discuss with the graphical presentation what is the gross and the net working capital. So, the left side of the figure tells you the amount of fixed liability, whereas the right side denotes the fixed assets. The lower part of this quadrant refers to the current liability and this is the current asset. Now, if the company has current asset equal to the current liability, that means though the company has working capital based on the gross concept of working capital, so this much current asset is denoting the working capital of the company, but there is no working capital, it is a zero working capital. But when the current asset reaches to this level, now company has some amount of current asset in excess of the current liability. So, this situation can be referred as the net working capital of the company. Now, this current asset of the company can be used to repay the current liability. So, this excess amount of current asset would be financed using the fixed liability and remaining portion of current asset would be financed through the current liability. Now, with this small example I would tell you how the working capital amount would be calculated based on the gross concept and the net working concept. Now, look at the figures. The liability includes the long term liability to the extent of 100, then asset, long term asset is also 100. Then current liability which includes the wage outstanding to the extent of 40, creditors 60. So, total current liability comes out to be 100, whereas the current asset comprises of raw material, work in progress, finished goods, receivable and the cash. So, total current asset is 150, whereas the current liability is only 100. So, if I have to calculate the working capital based on the gross concept and the net concept, we can include only the 150 as the current asset in the company, but if we have to go by the net working capital concept, then we have to see what is the total amount of current asset and the current liability, and excess of current asset over the current liability would actually give us the amount of working capital. So, this can be understood here. So, gross working capital is 150, but net working capital is 150 minus 100. So, only 50 that is the excess of current asset over the current liability is accepted as the amount of working capital. It is very logical because you cannot pay the current liability using your inventories and these debtors. It is actually the excess of current asset that a company has can be used to meet the current obligations. Now, there is another important things that we would like to share with you. What should be the sufficient amount of working capital? So, this can be calculated by having a ratio between the current asset and the current liability. So, if the ratio between the current asset current liability is above 1, that means current asset is equal to current liability or it is more than current liability. That means the business has positive working capital, thereby enough equity to meet its immediate obligation or the current liability. There can be another situation where the ratio between the current asset current liability is less than 1.0. So, this is the situation where the current assets are not sufficient to meet its current liability. That means, the company has a negative working capital and it might face the problem in covering its financial obligations. Now, the third situation may be where the assets, current assets and current liability ratio is between 1.2 to 2. So, this is the ideal condition which is considered to be a good indicator of the sound financial health of the company. But if it is more than 2, that does not mean that it is a very sound position, because if the working capital is too low, it is going to create problem in meeting the current obligations, but if it is too high, it means company has kept idle cash that would have been invested in some profitable projects to improve the earning of the company. So, these discussion on positive and negative working capital is important, because it is going to show whether the company has enough working capital, very high working capital or insufficient working capital. Now, there is another criteria to classify the working capital on the basis of time. So, there could be permanent working capital or the temporary working capital. So, permanent working capital refers to the minimum level of current asset that a business must maintain to ensure a smooth operation. That means, this amount of working capital is required throughout the year, regardless the peak demand or the low demand. This is the level of working capital which must be there in a company if the company does not want to interrupt its production process. This is also known as the fixed or the core working capital, because it has to be there in the company. Now, the temporary working capital, it is the additional working capital which is required to meet seasonal or the fluctuating demand of the business. Sometimes the industry nature is such that there will be some fluctuation in the sales and the demand for the product. So, in that case, the peak season would require higher amount of working capital, whereas the slack season may demand a comparatively lower amount of working capital. So, how to find out the temporary working capital? Thus, demand for working capital during the peak season minus the permanent working capital. So, this difference would tell us what is the temporary working capital in any company. How to differentiate between the permanent and the temporary working capital? So, we have got 4 dimensions. One, the nature. So, nature, as we have discussed, the permanent working capital is permanent, quite stable, and relatively it stays in the company for a longer period, whereas the temporary working capital is required only during the peak season. The demand for permanent working capital will remain stable because it is required throughout the year, but the temporary working capital is not required, because if your company is going to keep the same amount of working capital even during the slack season, it would have a cost for the company. So, company would be losing profitability at the cost of liquidity. Duration is permanent, and the longer duration is required in the case of permanent capital. Calculation, we have seen the total amount of working capital that is required throughout the season is considered to be the permanent capital, whereas the excess of working capital during the peak season minus the permanent core working capital is considered to be the temporary working capital. And financing of the permanent working capital comes from the long term sources of finances, whereas the temporary working capital can be financed through the current liability. Now, this is a pictorial presentation of the permanent working capital. We can see this shows the permanent working capital because there is a straight line and there is no fluctuation, but here we can see there is a temporary or the fluctuating working capital may reach to this level, or sometime it may reach to a very lower level. So, this is how we can see the difference between the permanent and the working capital. Now, what are the challenges before the working capital management? So, we know that the working capital management actually revolves around the 2 important concepts. One is the liquidity, or other is the profitability. So, if the company keeps too much working capital, it is naturally foregoing the good investment opportunity. So, liquidity is high, but this liquidity has been obtained at the cost of profitability. So, every time company has to have a trade off or equilibrium between the high amount of working capital and the optimum amount of working capital. So, what are the problems? The problems may emanate from the inadequate cash flow forecasting. So, there is no as foolproof technique to forecast the cash flow accurately. They can also be inefficient inventory management, where sometimes the inventory forecasting has not been able to predict the actual inventory requirement in the company. They can also be problem associated with the receivable collection, means the outstanding amount of receivables or credit sale has not been recovered by the company. So, that can again create a problem because of the delayed customer payment. So, most of the companies working capital will be tied up in the receivables. The poor accounts payable management system actually refers to the condition where the suppliers are not giving enough credit period to the company. So, that means it is getting the goods on credit basis, but it has to pay early. So, that can also create a problem in scheduling the payment to the supplier, and especially when it has not received the payment from its customer, but it has to pay to the supplier. Then inaccurate financial reporting can also be a cause of concern, where the errors or delay in reporting can provide misleading information that result in misinformed decision, and because of this company may overinvest in the working capital, or sometimes they can be insufficient working capital in the company. But this the challenges can be handled by having a very efficient working capital management process. And what is this process? This is actually a process of optimizing a company's liquidity to cover day-to-day operations while keeping the resources invested in a profitable way. That means, company has to forecast accurately that how much cash is sufficient to meet the current obligation and how much fund can be invested in some projects, maybe in the securities of the other company, so that some amount of return can also be generated on those current assets. Then this process can also be called as the establishing a trade off or equilibrium between the two important continuum, that is the liquidity or the profitability. And we know the liquidity can be attained only at the cost of profitability, and high profitability can be attained only at the cost of liquidity. So, this is a very important decision where management has to forecast accurately with the help of solid financial plannings and practices in place to balance the important element like the cash flow, inventory, account receivables and also the accounts payable. And once company has done it in an effective and efficient manner, what are the outcomes? The outcomes may be in terms of minimizing the risk, increased profitability of the company, ensure smooth operations, and also preparing for some unseen opportunities for growth, and also meeting out some contingency situations. So, the working capital management can never be neglected by any company. So, these are the benefits that we can show. Better account receivables and better accounts payable management, better fund utilization, collection systems can be efficient, and this would also help in meeting the short term liabilities. And if the company's working capital is good and the company is not facing illiquidity crisis, maybe the financial institutions have enough confidence in such company and would help with the additional fund requirement. Cash flow can also be very efficient where company is not facing the problem of illiquidity, and liquidity inventory cycle can also be optimized, ensuring that there is no insolvency risk coming in from the different corners. The working capital management techniques actually resort on three important pillars: how the cash flow is forecasted, how the inventory is managed, and how the account receivables are managed to collect them as and when they are becoming due with the customers. Now, we are coming to the last segment of this lecture, where we are going to discuss what are the factors affecting the working capital requirements. So, naturally the first important factor is the nature of business. Like if the company is largely in the field of producing essential or daily use goods or offering public utilities, then naturally it would require less working capital due to steady and reliable cash inflow. But if it is dealing in the luxury goods, naturally the demand would not be certain, and hence a sufficient amount of buffer stock of working capital need to be kept in the business. Size of business is directly associated with the size of working capital requirement. Higher the size, larger the size of business, and larger the requirement for the working capital. Demand of creditors, sometimes creditors they want company to maintain the enough pool of working capital, so that whenever their payment is due, it can be given by the company. So, with this a ratio 2:1 or at least 1:1 would be preferred by the creditors, just to ensure that their payment is made on time. The raw material, if it is very significant in the production process and they occupy a very high proportion of current assets, then naturally the demand for current the working capital would be high. Seasonal element would also keep on affecting the the working capital and its level in any company. And if the production cycle, I would already discuss the circular flow of working capital. If this cycle is very fast, and the cash is being converted into raw material, work in progress, finished goods, and again in cash at a very rapid pace, then company need not require enough stock of working capital. But if the cycle is very slow, then the company would definitely require higher level of working capital. Similarly, the trade cycle, which is the result of the economic cycle, would affect the working capital requirement, whether it is moderate or it is lower or it is very high demand, and it is in consonance with the business cycle, if it is a boom condition or it is the recession condition. Rate of business expansion would also affect the amount of working capital. If the company is expanding at a very high speed, the growth rate at which company is growing is very high, naturally it has to keep pace with the working capital requirement as well. So, with this we have discussed almost all the important variables coming from the external environment and also from the internal environment, and how they have a bearing on the working capital requirement. So, with this we have come to an end of this particular module, where we have discussed the important phenomena associated with the working capital, the concept of working capital, gross and net, permanent and the temporary working capital, and then how the working capital is calculated based on the two concepts, gross and the net working capital. Then what are the challenges of working capital, and finally how the level of working capital is determined in any business. So, with this I hope you have understood all the important ingredients. So, I wish you good luck and thank you so much.